Hello everyone, welcome to Question Hour 15, our monthly Q&A session on the economy, markets and investments. We have with us Mr. Sunil Subramaniam, Managing Director of Sundaram Mutual. Thank you for joining us, sir. We've got a ton of questions for you to answer, so whenever you're ready, can we get started?
Sure, shoot. Thank you.
All right, sir. The first
Good
question,
morning.
sir. With markets touching new highs and a little bit of volatility, is now the right time to enter markets?
I think that the fact that the markets are running at very high levels should not deter you from investing in the market. What you need to look at is what are the goals that you're trying to achieve through the market investment. And as long as those goals are 3 to 5 years at least away from today, the stock markets continue to remain good investment options. Over the next few months, there will be volatility. And I would suggest that if you're entering the market now, to enter it through a staggered investment approach, which can be either through SIPs or through STPs, where you park your money in liquid schemes and allocate, monthly, quarterly, weekly, whichever is your preferred mode, into the equity markets over the next 12 to 18 months, because that's the time period over which volatility is likely to persist.
Are there any particular funds you would recommend now?
So I would, from a fresh investment perspective, I would suggest that an investor should decide based on the tenor of his approach. So I would bifurcate these into a 5-year and less than 5 years. So if you're looking at it from that, and the second is your risk appetite, right? I would classify risk appetite as aggressive, moderate, and conservative. So the aggressive investors, I would suggest looking at a flexi cap or a multi-cap fund, which gives you access to all the three predominant share classes, which is large cap, mid cap, small cap. So I think over a period of time, this will deliver definitely very good value to you. If you are a bit moderate in your approach, I would suggest a hybrid category, where I would say the aggressive hybrid, which is allocating 70% to equity and 30% to debt, or the balanced advantage category, where the fund manager toggles around with the amount of debt and equity in the portfolio. So for moderate investors, these are ideally suited. If you're a little more conservative in your approach, then there is a category called equity savings funds. What is the specialty is that it allocates 1/3 to equity, 1/3 to debt, and 1/3 to arbitrage. So the arbitrage is a type of thing where the volatility, if it increases, arbitrage return increases. But for all taxation and other purposes, is treated as equity. So you are actually getting an equity fund, but which has a 60% stable kind of a return built into it. So for the conservative investors, I would suggest the equity savings fund, where between 30 to 35% of the equity appreciation, you will be able to gain benefit. However, if there is volatility and all of that, arbitrage will help you, but the equity component may correct, but you are then protected because of the debt. So these are the way I would look at it from a fresh investor's perspective.
Next question, sir. I'm expecting a reasonable correction in the markets. So would it be appropriate to divest up to 20% of equity and go in at the dips over the next 12 to 15 months?
Well, if that's your perception, then you should act according to your perception, because there is no guru or mantra who can tell you that the market has reached a peak. Market could reach even newer highs and then take a stronger correction too. So if your belief is that the market is going to correct, then what I would suggest, and you would like to re-enter on dip, I just mentioned about the equity savings category. I would suggest that you look at it as equity savings funds or as a pure arbitrage fund, as the place that you book profits and park it and then shift it. Because why do I say this is because both equity savings funds and arbitrage funds are classified as equity. So even if you are going to switch in the short term, your taxation impact of any gains that you make is only about 15%. And if you are going to do it after a year after switching the investment, the taxation comes down to 10%. Whereas if you put it in debt schemes, then you're taxed for the first 3 years at your marginal rate of taxation, which would be, depending on your tax bracket, would be either better or worse. So if you are in the high tax bracket, I would suggest to back your views to book the profit and to put it into equity savings or arbitrage, and then re-enter it on dips as you feel. This is all subject to the fact that your market view feels that there is a correction around the corner.
The next one, sir. Is the Indian stock market protected enough from external influence? How far could it grow in the current levels, or is it at a bubble already?
Well, I would say that the Indian stock market is absolutely not protected from international features because of two reasons. One is, as far as the equity markets are concerned, we have an open economy. FIS can put in money, pull out money, subject to the taxation rates whenever they want. So we are fully exposed to global liquidity flows. Similarly, on the economy front, the government has been opening up these sectors to international investment gradually over a period of time. So even economically, and India is heavily dependent because we are in labor surplus as a country on exports to other countries. So even on the economy front, we are very much linked to the way the world grows. So I would say India is extremely linked to the world, and there is no disconnection. There's no. Now the second point of your question, where you asked about the what was that, Shweta? Can you, if you don't mind, repeat the second half?
Yes, sir. How far would it grow in the next, in percentage terms, in the current levels, or is it a bubble already?
So the fact of whether it's a bubble, see the key point is that the market at this point in time has gone a bit ahead of the current earnings stream and projecting a very bright future, right? Now, is it a bubble or not? Only time will tell, because if the Indian economy goes through another downturn, this would have seemed a bubble. But all factors considered, given the way we have managed the second wave, given the way our vaccinations are progressing, given the strong structural strengths that India has, say, vis-a-vis China in terms of labor, the labor cost, the labor supply, as well as the government's very pro corporate outlook in terms of the PLI scheme and all other infrastructure development programs, the Indian economy's future is very bright. And in a bright future, the projection for the economy is about a high single-digit GDP growth post this current year, then from the next year onwards. So a stock market would generally deliver about 2 to 3% above that. So if you're satisfied with getting a double-digit return, a low double-digit return, I think that the current levels of the market are not a bubble and are not overvalued in that perspective. If you are expecting 20-30% returns and those don't happen and you feel this was a bubble, then your thinking is right. So I think that as long as you're looking at it from an alternatives perspective, you look at bank deposits are today at 5.5%. They are taxed at the highest marginal rate. Post tax, you will get sub 4%. So the bar for equity to beat is not very high. And if you get a 12% return from equity and take a 10% long-term taxation out, you're still getting almost 10.8, 11%, which is almost 3 times as what on a post-tax you're going to get from your bank deposits or other alternative instruments. So the equity markets, I think, are poised to deliver returns better than nominal GDP over the sustainable future, right? And to that extent, I would say that we are not in a bubble situation, right? The bounce back in earnings, which is expected, I think will more or less happen.
Next one, sir. Why are returns from mutual funds not as much as equities?
Well, that's because you're tending to not compare apples with apples. You're comparing apples with oranges. Because when you look at equities, you look at the high performing stocks and say that the mutual fund didn't return as much as that high performing stock. But there are lots of low performing stocks that have given negative returns. A mutual fund manager, when he takes a position, he cannot concentrate his portfolio in just a few stocks. The mantra of mutual fund is diversification because you can reduce the risk but not give up an equal amount of the reward. That's the essence of mutual funds. So at any point of time, no mutual fund will beat the returns of the best stock, but every mutual fund will beat the returns of the worst stock. So it will be always in the middle. So you have to look at, with a minimized risk, what kind of a reward you want. Because individually putting in stocks, you're taking on the risk without the diversification which a mutual fund brings, without the expertise that a analyst at the mutual fund brings to the table. So I would argue that you should always look at mutual funds as a middle of the road path and compare it to where else you can put your money. When you're directly investing in stocks, then it's an entirely different kettle of fish, and your own stock picking may beat a mutual fund. That's all credit to you, but it's not the thing that you can predict sustainably for the future, that always your stock picks will beat a mutual funds pick. So I would argue that mutual funds are a much better vehicle for wealth creation than individual stock exposure.
The next question, sir. In this unprecedented bull run, for valuing a company, PE ratio has become redundant. So, what other methodology except DCF can we use to ascertain a company's true intrinsic value, or should we just settle with qualitative patterns?
I think that as far as the old economy is concerned, the P/E ratio still continues to be a valuable tool. It is as far as the new economy is concerned, where there are going to be exponential growth rates that your traditional models don't can't factor in those kind of things. Now there are three other ratios which help in the absence of DCF, and one is that you can look at what is called a PE growth. You look at the growth rate of the company and take the PE and divide it by the growth rate, right? So that will give you a fairly normal one. The second thing is to look at similar models of companies which are listed in the developed countries and look at their progression and how they did it. That's the second way to look at it. The third way is to always pick a basket of these new age companies, right? Where traditional models don't work, but pick a basket of, let's say, 10 or 15 companies. And the issue with these new age companies is that they are, all of them reflect valuations as if super growth is ahead, but there will be a few winners only in that basket and the others will be failures. So if you pick a basket of this new age, then don't worry about valuations, because in that basket you're likely to find three or four winners which will make up, more than make up for the losses you may suffer in the rest, and give you a healthy return. So a diversified approach to new age companies by spreading your risk across it, because traditional models don't fit, would be a smarter way to approach the investment there.
The next one, sir. Is real estate sector picking up? If it is, how long?
I think the real estate is picking up because it's been through a prolonged downturn, because it started from demonetization, continued with the GST and the formalization developments. Then the crisis around the world hit it. So I think it's been through a fairly difficult time. But now with interest rates dropping to all-time lows, housing loans are at sub 6.5% levels, with the fact that people's incomes haven't got damaged during the pandemic as much as anticipated, so the consumer surpluses are higher. Right now, I think the real estate sector is getting a fresh leg of recovery, and it's likely to get a lot of regulatory support from the government. For example, stuff like RERA gives a lot of confidence to buyers, right? Stamp duty is at the state level, so states will promote it. So I think real estate is set for a fairly prolonged period of run, and the reason that it will get prominence in the government's actions is because it's also the biggest employment generator, as well as a multiplier effect, because 10 to 12 other feeder industries feed off the real estate, like cement, building materials, paints, your PVC pipes, your sanitary ware, your tiles. So there's a whole range, cement, steel. So the whole range of industries which benefit from that. So it gives a multiplier effect to the economy. So in any government's agenda, it should be top of the mind to give it a good boost. So I think real estate is in for a reasonably secular bull run over the next decade.
The next one, sir. With the stock market booming, will this help drive other industries as investors churn or rebalance their portfolios?
Can you repeat the question?
With the stock market booming,
Yes.
Yes, sir. With the stock market booming, will this help drive other industries as investors churn or rebalance their portfolios?
Not necessarily. I think the two are disconnected. A booming stock market and investors churning their portfolio, right? It means that people will make gains. Now, what they do with the gains? If they take those gains to go and buy those aspirational goods, a Mercedes Benz or a big villa or something less, yes, those industries will get a boost. But if people are enamored of the gains and then put it back into the stock market, it's only the stock market which will continue to boom and not necessarily benefit. So consumer mindset in terms of taking the gains from the stock market to fulfill their aspirations, that's a move we need to wait and see as to how people react. That's number one. Second way that a stock market boom will help the overall industries is that companies which are smart, which have a high debt burden, will take this opportunity to issue fresh shares in the market, as called as an FPO, a follow-on public offering or a rights offering, and they will take that money and bring down their debt, thereby achieving a permanent reduction in their interest costs in their earnings projection. So naturally, they will be much healthier companies, will be able to raise financing at much cheaper levels from their bankers and finance their growth also adequately. So booming stock market will help a lot of these high leverage industries because they will be able to get more capital into their businesses and ensure a sustainable growth.
The next question, sir. Will close-ended funds maturing in 2021 and 2022 still give good returns? How will you safeguard growth in those funds if market crashes at the time of its maturity?
I think as far as our specific funds are concerned, I think all of them are trading above par. So I think the recent boom has helped them. And we are gradually moving into a safer stocks and a larger cap portfolio to the extent possible. And closer to the maturity, we will try to move it into cash to the extent that regulations permit. And that's the way we plan to protect the gains for the investors.
The next one, sir. What is your view on the fast jump in the Sensex to 60K? Will this sustain? Small businesses seem to be struggling, but markets are at a high.
Yes, businesses are struggling because of the economy is still recovering from the first wave, second wave. The markets are benefiting from liquidity, which is not connected with the economy, so much to speak, because the markets are always future looking. And they say that the economy will cross this temporary hurdle and will bounce back fast. So that's why the markets supported by liquidity are running at a high. Now, the Sensex run up to 60. Will it sustain? Obviously, it cannot sustain at the pace at which it has grown because there's been a lot of liquidity thanks to the liquidity pumped by the Fed and the ECB. Now, you must be hearing the recent news of the Fed starting to talk tapering by the end of the year and interest rate hikes by the end of next year. So, naturally, there will be a contraction in the liquidity, and hence the market will not get the same amount of liquidity support that it got over the last 18 months post the pandemic. So, while the markets now, the new direction of growth will not be liquidity driven, but economic revival and the V-shaped recovery that's happening and the pent-up demand that's likely to come. So there will be good returns, but do not expect the pace with which the Sensex went to 60,000 to immediately sustain. But there will be a little more gradual growth. There will be volatility because liquidity may get pulled out in clumps and there will be corrections. But new age investors like mutual funds and others who are getting fresh money from the public will continue to buy them. So you will see a volatility combined with a more, I would say, Hindu rate of growth rather than this explosive growth, which was essentially fueled by liquidity from external sources.
The next one, sir. What are the effects of the ongoing crisis in the real estate giant Evergrande of China on our Indian economy? Do you feel it will further boost the view of China plus one in the context of India?
So to the first one, I don't expect a very limited impact because I think it's a very local issue, and the Chinese government has been known in the past to ring fence these issues and handle it. Evergrande may even be allowed to fail, but the contagion effect will be controlled by the Chinese government, is my feeling. Now, in terms of your question on China plus one, I don't think that the real estate sector is a sector because our focus in the China plus one is to the stuff that China exports, which we want to substitute. We want to become the China plus one for the export industry. The real estate industry is clearly not an export industry. So I don't think Evergrande will have a direct impact on our China plus one strategy. On the contrary, what Evergrande will do is maybe the perception of China in foreign investors' minds may alter. So we might get a lot more FII, FDI flows into our country because they'll see India as a safer place to deal with. So some of the marginal shift there will help. That will come and help to the extent, to some extent. Your second question.
The next question, sir. Could you explain in simple terms the reason behind markets bolting like a train without brakes, whereas the ground realities are starkly different?
So I think the market is very simply a culmination of people's thought processes who have money in their hands. Now, the larger part of the economy may not have money. A small part of the economy has money in the hands. Markets are driven by how the people with money in their hands behave. Whereas the economy is driven by all kinds of people, not necessarily people only with money in their hand. So clearly the pandemic and the fact that even pre-pandemic Indian economy was in a slowdown has had its effects on the economy. But the people with money in the hand, they operate from basically two poles, right? One is for fear, one is for greed, right? So what they have seen is they acted with fear in the post-pandemic world, saw the markets rising because of external people putting in money, FIIs, and they saw that they were missing out on returns. So they have now, with double vigor, turned on their greed button. So this interplay between fear and greed, and the fact that there is a very limited amount of stocks available in a country our size, your 500 stocks is nothing. So this chase of a lot of money behind a very little stocks means that there is this horse bolting kind of a phenomenon which you'll see. But bear in mind that when fear overtakes greed, the reverse to a horse bolting scenario can also take place with equal rapidity. And coincidentally, that might happen at a time that the economic numbers are looking good. So you will then ask me the question, so the economy is looking good, why is the market going through volatility? It is the same reason, because ultimately, end of the day, it's human emotions at play of the people who have money in their hand.
The next one, sir. If I book profits now, then where should I invest this, in an NFO or somewhere else?
No, I would suggest strongly that if the profits you book don't have an end use in mind, like I said, when you invested, did you intend to do something, take a big holiday, buy a big house, buy a big car? Do that, right? Because that goal needs to be achieved and satisfied. That's one. Second is, if you feel that the correction is a time to just stay away from the market and re-enter. I answered this question a few minutes ago. My suggestion to you is to look at the equity savings fund category actively as the ideal place to park money, and then re-switch it back to equity when you feel that the timing is right. And alternative would also be balanced advantage funds. So these two categories should be where you should park your money.
The next question, sir. Where do you think markets will be in the next 12 to 18 months for large, mid, small caps and the agriculture sector?
I think it's too short a time. 12 to 18 months is going to be extremely volatile. So I would hesitate to hazard a prediction on the direction of the end point of the market in 12 to 18 months. I think we are in, because I mentioned some time back, Fed is going to do tapering by end of this year and going to do interest rate hike by end of next year. So it's exactly in the 12 to 18 months. And so there is too much uncertainty around the timing of those, the impact of those, the US economy's growth numbers, the unemployment numbers, US economy. I think there are too many factors at play. All I can guarantee to you is that there will be volatility, but I cannot talk about what the end result will be in such a short time frame.
The next one, sir. Do you think this commodity price surge is synthetic, and how can this price pressure be alleviated? How long can these high prices sustain?
So I think the commodity price rise is partly driven by the boom in the growth that was there in China pre this Evergrande crisis, right? And also the fact that the US is showing signs of recovery. So the commodity markets actually also read into the future very much like the equity markets. So if they see a time of demand for commodities, because US is going to spend a huge amount on infrastructure, for example, so all those commodities needed to satisfy that infrastructure spend will naturally rise, and the markets are impatient. So a future expectation of a boom means the prices rise today, right? So is there a way to control it? Absolutely impossible, because huge big money players are at play, and there are the options and the futures trades which happen. There are speculators coming and playing. So commodity is a very hazardous game. One can't predict it and one can't control it. As a user, the only way to control the impact of commodities is to hedge the commodities. But that's more like there are experts in every company in the purchasing manager section who hedge their future commodity requirements so that they get some amount of certainty to the prices. But they cannot control the prices. They cannot reduce the prices when the prices are rising.
The next one, sir. Any Sundaram NFO coming?
Well, not in the near future. We are awaiting SEBI approval, and our first task is to complete the merger. Once the merger is approved, we will have gaps. We think that the flexi cap category is going to be a space where we will not have a fund, and so an NFO can be expected. But the timing of the NFO will have to wait for the SEBI approval, the transition to finish, and then we will launch that NFO. So most likely, the flexi cap will be the first NFO we will launch post the merger.
The next one, sir. Will Sundaram Tax Saver pay dividends going forward?
It has already been paying dividends for the last 5 quarters consistently. So I do expect it to continue to do that, subject to availability of distributable surpluses based on the fund's performance.
The next, sir, the status of the principal mutual fund daily.
It's awaiting SEBI approval. Otherwise, we are ready. We have done all the homework and groundwork, and everything is kept in readiness. The moment SEBI approves it, we are good to go in a matter of 45 to 60 days. We should be able to complete all the remaining bureaucratic paperwork and the notices and all of that.
The next one, sir. I'm 83 and my wife is about 80. Due to age, I can't opt for speculative investments that might fetch me more income. So could you suggest a safe investment for about 50 lakhs?
I would suggest equity savings funds as a safer investment because it takes about a third exposure to equity, a third to arbitrage, and third to debt. So I would say at your age, that's probably a better investment to make because your downside will be protected because exposure is limited, but your upside also you will gain something because of that. So I would encourage you to look at the equity savings funds as a safer category at your age and given your profile.
The next one, sir. I'm currently doing an STP from Sundaram Select Focus to Sundaram Small Cap Direct Growth. I would like to understand what should be the criteria for starting an STP. Like, how do I select a fund? And are these funds beneficial to me or not for STP?
So it all depends on the time frame in your mind. So when you're doing into the small cap, I suggest to have at least a 5-year outlook, right? Anything shorter than that, you can't. The small cap segment is very volatile in terms of its outperformance and underperformance. You're doing an STP from Select Focus, right? That's a large cap concentrated fund, but it's also because it's concentrated in high risk, high reward. So you are actually shifting from one risk reward into the same risk reward, right? So what I would suggest for STP is that you use equity savings funds as your base fund and then allocate it into a mix of large cap, mid cap, small cap, so that over a period of time, whichever cap curve does better, you will ultimately benefit. So my suggestion is use equity savings funds as the base fund and use a large cap fund. And within large cap, I would actually suggest that you go for funds like the blue chip fund, which are playing quality and safer. The mid cap fund and the small cap fund has three funds of the recipients of the STP. Setting up an STP is easy. Just go to our website and click on the things. It will guide you through.
The next one, sir. Are you launching any global fund of funds like HDFC? There are many investors who are interested.
Well, we'll continuously evaluate these products, but like I just mentioned, our current energies and efforts are on obtaining the principal merger approval and executing that. So our management time is devoted to that. Once that is over, we will look at all opportunities in terms of available. We already do have a global brand fund, which I would encourage you to look at, which is a very well-positioned fund to capture the growth, and it's a very high-quality fund because it deals only with the top 30 brands of the world. So I would encourage you to look at that for your portfolio.
The next one, sir. Can we still invest in domestic facing pharma given the run?
So I would say pharma has had its dream run, right? I think going forward, you'll get a more healthier, more normalized kind of a return as you will get. What is the domestic facing pharma? The pharma, one of the gains we can expect is from the export side with the expectation of rupee to depreciate. So does domestic facing pharma will have a good thing because awareness of medical things in the public has improved thanks to the COVID impact. So demand for those kind of products and everything will go up definitely. And the penetration of insurance means more people will be willing to get hospitalized and get treated for stuff. So yes, the outlook is fairly good for pharma, but just don't expect the kind of windfall gains that you saw in the past because of the pandemic to come forward in the future. It's a good addition to your portfolio from a safer aspect.
The next one, sir. Could you please suggest a fund for retirement, medium risk with a minimum return of 7.5%?
Now, the equity markets are volatile and all mutual funds in equities. So, getting a 7.5% return consistently is not something that any mutual fund can guarantee. There's no mutual fund is allowed to guarantee any returns, and 7.5% return to you. So, the only way I would suggest is choose a safer basket, right? Like a balance advantage fund if you're very conservative, or a flexi cap fund or a multi cap fund if you're a little more aggressive. And what I would suggest is that use a systematic withdrawal plan. It's take your money because as the fund grows, those profits rather than depend on the fund manager to give you, set up a 7.5% divided by 12 STP every month with systematic withdrawal plan, SWP every month. In some months, the returns would more than compensate for your withdrawal. Some months would not. But over a long period of time, I think 7.5% return from a equity fund is a reasonable expectation. So I would suggest that you use the systematic withdrawal plan in a flexi cap, multi cap fund to get your regular cash flows.
The next one, sir. Excellent digital visibility for Sundaram, sir. When will fund performance be back to the old days? What is the status of CIO appointment?
Well, the fund performance is work in progress. There's been some change of personnel, as you would have been aware. We are merging the principal mutual fund, awaiting SEBI approvals. So they have a good quality set of fund managers. So they will be joining us on board. Already internally, the process towards improving fund performance is all well underway. And we have identified Mr. Ravi Gopalakrishnan of principal as the new CIO. He has accepted the offer, but it's conditional on the principal deal being closed. So he cannot join us till the principal deal is closed, but the name has been identified. So I think that, so with all of this happening, Ravi will take over the thing. I'm sure that very soon you can expect a fund performance to come back on track.
The next one, sir. Is there any mutual fund with you? Like if I invest, say, 15 lakh lump sum, will I get a monthly payment of 10 to 12,000 from the very next month of investment, and also my fund grows?
Well, you're asking for the near impossible, because once you take out money, how the fund, there's a limited amount of corpus left for it to grow. So there are funds which do try and give regular dividends, or balanced fund, equity hybrid, aggressive hybrid, it's called. Just try to give out regular dividends on a monthly basis. It has been successful over the past 2 years still doing that, but I cannot guarantee to you that we'll continue to do that. The effort and the attempt is there to give monthly returns, but please remember, any monthly returns you give to you comes at the expense of growth. So expecting you to get monthly returns and growth at the same time is, I would believe, a very, very difficult and challenging task for any fund to achieve. So please bear that in mind very, very clearly. If you want income, it tries to give you that regular cash flow to what is called as the IDCW. The old dividend has now been renamed as capital gains and capital withdrawal and distributable surplus. So I would suggest that you use the systematic withdrawal plan, which I suggested to another question now today, as a way to generate that income, right? And you can choose any equity fund for that. Set up a systematic withdrawal plan for the amount that you want, and the growth which should hopefully compensate for that kind of return for a period of time.
The next question, sir. How can we invest in US markets other than fund of funds?
Well, you can directly invest. A lot of stockbrokers offer the option to buy US stocks directly. If you so wish to do that, you can do that to any stockbroker. Other than that, most mutual funds in India, right, have to depend on the fund and funds route, because we have mutual funds in India, and hence we like to use mutual funds abroad to make sure that the risk reward equation is favorable. So I think otherwise that's the preferred option from the industry.
The next one, sir. Could you elaborate the performance of Sundaram Midcap and when it will do better?
So the Midcap Fund had taken a very strong pro-domestic economy, pro-infrastructure, pro-cyclical, and had also benchmark put itself into the lower end of the cap curve. So it had about 60-70% mid-caps and 20-25% small caps historically. So the fact that in the initial period from 2017 December onwards, till the pandemic hit and the first few months of the pandemic, the mid and small cap segment itself underperformed, and Indian economy oriented. It was the pharma, IT, and those stocks which did well. The fund missed out on those gains. And in the small cap and mid cap, it's not easy to switch portfolios, because being very smaller companies, when you go and sell, two things happen: there won't be enough buyers, or second, even if you sell, there will be an impact cost, because the act of selling itself brings down the price. So that position historically had helped it, because the Indian economy over a period has been on a boom. But since 17, when the downturn happened, the fund had not been able to capture the upside, and got hit on the downside. We have since rejigged the portfolio. We brought down the small cap to below 10%. We have added 10 to 12% large caps. We have made it now more of a diversified portfolio, not just domestic economy sensitive, and added to it So those things are already beginning to pay rich rewards, because if you see the performance 6 months ago on a 1 year, 3 year basis versus the benchmark and the performance today, you'll see there's a strong improvement. Yes, there is still some miles to go, and I'm confident that over the next 6 months to a year, we will be able to bring that fund back on track, and it will soon become a top performing fund in its mid cap space very shortly thereafter.
The next question, sir. I've invested 25 lakhs in Sundaram Diversified Fund and now it's 28 lakhs. Should I redeem or wait more? Can my fund value touch 30 lakhs?
Absolutely. You just have to wait. The fund went through the same challenges as the mid cap fund did. So there are a high concentration of mid and small caps in its portfolio. That recheck has already happened. It's now 80% large caps. It has come back on the dividend track record, and the fund performance is improving. So I think that sooner or later it will reach the desired sum that you have in your mind. Not to worry.
The next one, sir. Will you be launching silver ETFs soon?
We are not a very big believer in passive funds. We only have one Nifty equal weighted index fund. Otherwise, Sundaram has been completely absent from the passives. It's not a active strategic call at our end. We don't believe in, we believe that we are active managers, and our time and efforts is better spent on active. So we have no plans to launch any ETFs on silver, because we don't understand commodities and we don't intend to be in passive.
The next one, sir. Why are Sundaram funds not in the top performing category in the recent past as compared to a decade ago?
I explained that because we had heavily pitched our thing in line with the domestic economic growth, which went through its phases and challenges announced by COVID. And that's the reason that the earlier super outperformance has come down. But if you notice the funds that we have launched recently, the services fund, the blue chip fund, all of them doing extremely well. The large and mid cap fund have been doing extremely well because the funds which are launched recently have been positioned to the current flavor. But the older funds having been very domestic sensitive, and because a large number of mid and small cap made it very difficult to churn the portfolio to meet the newer needs, they are taking a bit more time to catch up. So I request your patience there, and soon we will be back on track across the spectrum. But right now, if you look at our, like I mentioned, services fund, blue chip fund, large and mid cap fund, these are all doing very, very well.
The next one, sir. Which portfolios under Sundaram MF are suitable for a small investor, a senior citizen? Investor requires a small horizon, safe in the sense better than an FD, and prefers a lump sum.
Well, I can't guarantee that every month on month you will get a return better than an FD. But if you hang in there for 3 to 5 years, I think there's a reasonable expectation of FD beating returns. So I would suggest that from the way you pitch the question, you're very sensitive to risk. So I would urge you to look at the balance advantage fund as the ideal fund, because there is a flexibility to use debt and equity in interchangeable proportions to manage risk and reward.
The next one, sir. What is the future of mid-cap IT stocks?
I can't be very specific to that. I think overall IT has a good future because the pandemic has proved to be another Y2K moment. The shift to cloud, the shift to work from home, the shift to Internet of Things and artificial intelligence, I think are going to benefit IT companies across the curve, large cap, mid cap, and small cap.
The next one, sir. Is it a good idea to withdraw some profits from PMS and invest in gold, given that the market rally cannot go on forever and, to spread risk? Or should we again put the lump sum in existing holdings of MFs?
So again, I would suggest gold is not a good option at this point in time. Gold has had its run because gold is something that does well when there is fear in the market, fear of inflation, fear of wars, fear of recession, whatever fears. I don't think we are now in a position of recovering. So I don't expect gold to be that outperforming, space over the next few years. So if you have made good profits in your PMS, then I would still suggest that given that there is volatility ahead, I would suggest you look at the balance advantage and the equity savings funds as categories where you park your money, from where you can re-enter the equity markets as and when there are corrections.
The next one, sir. Which would be preferable to invest, keeping in view the coming 3 years, large, mid, or small caps?
Again, with a 3-year perspective, I would argue that a combination of large and mid would be well suited to you. If your horizon can be extended to 5 years plus, then I would suggest that mid and small would outperform large caps.
The next one, sir. Is a reduction of tenor or removal of exit load in balanced advantage fund being considered?
We would like to encourage longer term investments. So reducing the exit load tenor means we're encouraging people to stay short term. So that's not on the anvil. The other one was, what is the other question there? Tenor and?
The exit load, sir, removal.
No. So the purpose of the exit load is to sensitize the investor to stay long term. Now we're constantly evaluating the situation on exit loads and whether they are very effective and what quantum they should be. So as things stand now, we have no plans to change any exit load. I think already we have given a waiver of 25% of your holdings you can take out within 1 year without exit load. I think that waiver is already there. And I think the exit load is also very reasonable, 1%. So I don't think that should be a significant part of your decision making, because ideally we want equity-based investors to look at a 3 to 5 year horizon. So the 1 year exit load is just to disincentivize short-term speculative players to come in and book profits and go away and cause damage to other investors in the fund who are primarily longer.
Next one, sir. How are PMS compared with mutual funds as an investment option?
PMS is more high risk, high reward, most concentrated portfolios. So they are the opposite of diversification. So sometimes when the concentrated picks go very well, they can outperform MFs. Sometimes when the concentrated picks don't go well, they will underperform MFs. So MFs are diversified, PMFs are concentrated. I think that's simple mantra in your head. So they are more high risk than MF. So you can allocate according to your risk appetite on how much to put in PMS and how much in MF.
The next one, sir. How does expense ratio impact an investor's earnings?
Nothing. An expense ratio is basically investor, whatever the returns that the mutual fund makes minus the expense ratio is the investor's earnings. The smaller the expense ratio, the better the investor's earnings. But if that fund manager of a larger expense ratio fund is able to deliver that much extra return, then investor earnings will not get impacted. So I would suggest that given that expense ratios hover anywhere between 1.25 to 2.25 percentages, the returns that you are expecting from the market are obviously multiple times that. They shouldn't become a critical factor in your decision making, is my suggestion. Look at the quality of the fund manager and the track record rather than at the quantum of the expense.
The next one, sir. Could you name some funds which will give me around 12% for long term, about 3 years?
No, I can't give you any guaranteed returns like that in 12% and all that. I think overall stock market over a 5 to 10 year perspective will be able to give the 12% kind of returns. But some funds may outperform, some funds may underperform. And those picks are not something that we can guarantee that this particular fund of mine is going to outperform this one. We put the same effort behind all our funds, and we hope that we will be able to capture the market returns, which I expect to be around 12% over the medium term. So it will not be fair of my part to pick a fund and say this will definitely give 12%. That's not in my hand.
The next one, sir. Should I invest directly in stocks or through mutual funds?
No, I think I would always suggest that you invest through mutual funds, because stocks, the level of information you need to analyze to buy a stock, it's the resources, the computer tools, the spreadsheets, the access to the companies are not available to individual stock investors. So I would say that at any day, a mutual fund is a better bet, because bear in mind that don't look only at reward, look at the risk you took to earn that reward. Mutual funds through diversification and expertise are essentially trying to minimize the risk and maximize the reward, right? So I would encourage you to always look at mutual funds as your preferred investment vehicle.
The next question, sir. What will be the scenario of mutual funds in the near future?
I think that's a very broad-based question. In terms of you're expecting the returns of the past few months to reflect in the next few months, that's hard to say, because I think that there are concerns ahead in terms of the liquidity tap being turned off through tapering and the interest rates going up. So this is going to be a volatile time. So I think that the near future, expect a volatile stock market and volatile mutual fund performance.
The next one, sir. What is the risk involved in case I invest in your mutual funds?
The risk involved is that the fund manager will diversify. So you will get the benefit of diversification, but the risk is that the kind of sector choices and the stock choices he does may not be reflected in the market. He may have a 3 to 5 year view, but market changes his view every few days. So in the short term, there could be underperformance, but over a long term, the fund manager will look at that and do a course correction. And so I think that the risk in the short term is that his views of what's going to do well in the economy and the market's actual action could be a divergence. And so you could have underperformance coming in.
The next one, sir. I'm from a middle class family. Could you please guide me best mutual funds in your side?
So it depends on your risk appetite. Middle class. So I assume when you say middle class, you want to say that you are fairly risk averse. So I would encourage you to look at the multi-cap fund and the balance advantage fund and the equity saving funds as the funds where the multi-cap fund is at the higher risk end, the balance advantage is in the middle, and the equity savings is the least risky within the equity basket. So suggest an allocation to those three funds.
The next one, sir. Is this the right time to move from equity to debt with Nifty and Sensex at an all-time high and rebalance the portfolio?
Not necessarily. I would suggest that if you want to move and you feel that the valuations are high and the market is overvalued, I would still suggest the equity savings fund, and the arbitrage fund. These are two funds which are equity taxation. So when you move to debt, the debt taxation is adverse to equity. So staying within equities, but in the lowest risk equities is the equity savings fund and the arbitrage fund. So I would encourage you to park your money there so that then you can re-enter very easily. In the debt funds, not only is the taxation adverse to you, the other aspect with debt funds is that interest rate cycle is expected to rise in the near term. Since you're stuck for 3 years from a taxation perspective, you want to get reasonably better taxation, you have to wait for 3 years in a debt fund. But in that 3 years' time, if interest rates are spiked up, you will get mark-to-market losses in your portfolio. So I would not encourage you with that intention to do that. If you feel that post-tax 5 years, you're willing to wait and get a reasonably better return than FDs, then debt funds are a better option. But if you intend to re-enter the equity markets, then I would suggest equity savings funds and arbitrage funds as good tax efficient vehicles for you to park your money and move back to equities as and when you feel the time is right.
In the interest of time, sir, we'll just take one last question.
Sure.
What is the outlook on the Indian economy?
The outlook on the Indian economy is very, very robust and very good. Because in the short run, we expect that the vaccination story, as it keeps improving, that any third wave or fourth wave, its impact would be limited. And there is a pent-up demand because we've been through a year of suppressed expenditure, people wanting to go out to malls, everything. They have not been able to do that. So there'll be a pent-up V-shaped recovery for the short term. Then there'll be a plateauing. But in the longer term, there are strong cyclical structural factors like our demographic dividend, our youth of our population, the fact that government is implementing a China plus one strategy, the fact that exports for India are expected to grow at a rapid rate, all of these coming together and the infrastructure plans of the government and of the private sector means that the Indian economy is set for a sustained period of high single-digit growth, in my opinion. So I would say that the economic outlook for India is probably never been better over the last 3 to 5 years. If you look at it's right now looking in a very decent space.
Thank you, sir, for taking out the time to answer these questions. For those unanswered, we'll leave the answers in the comments. Thank you for watching question hour 15.
Thank you and stay safe, all of you.
Yeah.